We detailed several different individual policies in this lesson, everything from simple term policies to more complicated contracts like universal life. We then moved into specialized contracts and group insurance policies, which are markedly different from individual coverages. Term insurance only provides coverage for a period or term of time. At the end of the term, the policy is over. Term insurance and permanent insurance can be compared like this. Term insurance is more like renting a house or apartment. When you rent, there are typical rent increases when the rental agreement renews. Just like if a term insurance policy renews, the costs will increase. Another similarity is that when you leave a rental, you get nothing out of it. On the other hand, permanent coverage is more like buying a house. So we looked at whole life, the first permanent insurance contract covered in the course, and we referred to the cash value in a policy as the owner's equity in the policy. As more premium is paid into the policy's cash value account, the equity in the policy will grow, just like when mortgage payments are made. Conventional mortgages have the same mortgage payment every month. This could be called a level mortgage payment. Whole life policies also have a level or unchanging premium requirement. One of the more important aspects of whole life coverage is the cash value. Be sure to understand the relationship of cash to risk in the policy and how these figures come into play when the contract endows at the end of the policy period, if the insured is still alive. You learned that whole life and other permanent insurance has different methods of paying premiums that are made available to the applicant. These will be tested, so go through them repeatedly. We then learned about flexible premium policies like adjustable and universal life. More complicated than ordinary whole life policies, these contracts have attributes that whole life simply does not. Make sure to understand the differences, especially when it comes to issues such as the two death benefit options available in a universal life policy, the different interest rates payable to those contracts, and how a policy owner can change certain terms of these policies. Next, we looked at a few specialized insurance policies, for instance, joint life and juvenile insurance contracts. These offer protection for situations that other policies can't, such as covering more than one person on a single policy or providing coverage for a child's life. We concluded this lesson with a detailed view of group insurance coverage. There are many differences in group when compared to individual coverage. Remember, a group policy owner is referred to as a sponsor. And keep in mind that the insured group members don't receive policies. Instead, they get certificates of insurance. It's important that you remember and understand the participation requirements and whether a plan is contributory or non-contributory. We also looked at issues such as open and closed enrollment periods and the implications of trying to enroll at the wrong time. We briefly discussed provisions in the group contract such as incontestability and misstatement of age or gender. Finally, we worked with credit life. This is insurance offered by lending institutions when a loan is granted. Credit life policies have no underwriting requirements or proof of health mandates. They're open to all. Because of this, the rates charged for credit life insurance tend to be more expensive compared to individual insurance, but only for healthy persons. If a person is unhealthy, an individual policy could easily be more expensive. And if a person is uninsurable, credit life may be the only choice.